Hi everyone, we are starting with a new chapter financial market. This is chapter 10 if we take the chronology of both the books, otherwise it's the chapter 2 of book 2. Starting with financial market. We just finished off financial management and we talked about what are the financial needs of a business firm. Now the financial needs of a business firm talks about the fixed capital needs and the working capital needs, where we procure the fixed capital in form of fixed assets, that is land, building, equipment, etc. And when we talk about working capital, we talk about day-to-day expenses, we talk about current assets and liabilities and everything. So that all together, how will a company arrange funds? How will a company arrange funds? Even if the company owner has his own money, which he puts into the business, after some time he wants to expand it. So where will he get the funds from? We studied about the proportion of debt and equity, the mix of debt and equity. Debt is a cheaper source of finance. Equity comparatively needs to be properly floated or issued through a proper system. That proper system of flotation of funds you've done in the formation of company in the 7th chapter of plus 1. So all these things combined together, where does a company get the funds from? Where does the owner get the funds from? So he has a very beautiful option apart from the financial institutions, apart from the commercial banks, apart from the private money lenders or unorganized markets. In case if he goes to, he has another option, and that option is nothing else but the financial market. Now why go to a financial market? There's a reason for going to a financial market. There are few reasons, and the first one starts is that business is part of an economic system and it has got two main sectors, households and business firms. Now what do the households do and what do the business firms do? Business firms are always in need of funds, and what households do is, now they don't put the money at home. They don't, whatever savings they have, they don't put it at home, they put it in a bank. In case if these household people put the money at home, it will not multiply for them also. So what they do is they put it in a bank, even with a low rate of interest, they are happy about it. The second option they have is either they put it in the bank or they put it in the financial market. Wherever they will put it, business firms will go and borrow from there. How does it work? I'll explain. Household are savers out here. They have the option of going to the banks and they have the option of going to the financial markets. Now, if they go to the bank, ultimately, what will the business firm do? As an investor, it will go to the bank and it will borrow from bank. Okay, they take loans. Business firms take loan from the bank. Okay, so the business firms get their money to expand their business. If not, then what? If not, then the people, the household savers, can also go to the financial market. The moment they go to the financial market, they are investing in a business firm and the business firm is getting money to expand its business. So either of the ways, those people who are saving, those who are household, we all, when we are saving our money, either we are putting in the bank or to the financial market, either of the ways, the money goes to the business firms and business firms can easily expand. So the best option for the business firm usually is to extend itself in a financial market or the capital market. When they extend themselves to the financial market, what happens is they have a wide open market where people can come and buy the shares of their company. The shares can be preference shares, debenture, equity shares, and they can also be debentures. When we talk about shares, equity, they become the owners, preference shares, hybrid securities. When we talk about the debentures, it's an acknowledgement of debt. The savers or the household people become the creditors of the company and company owes money to them, or they can also issue another kind of a security which is called a bond. So whatever they issue, whichever type of shares they float in the market or whatever kind of securities they float in the market, when savers buy them, they are investing, they get high rate of return and the complete process of financial market starts working. Let's study about financial market. What is a financial market and what are we talking about when we are defining the financial market? Financial market is a link between investors and savers. Yes, it is a link between investors and saver. Here investor we mean business firms and savers are the households. So when we talk about a financial market, what all it tells about, how it mobilizes the fund, let's understand that. Financial market is a market for creation and exchange of financial assets. Now, what are the financial assets out here? Financial assets are your shares, debentures, everything. It helps in mobilization of savings and channelizing them to most productive uses. This saving, had it been kept at home by the households, would have not gone into productive use. It would have been at home, they would have purchased gold, silver, but gold and silver, when it goes high, at that time it gives returns. Whereas when they invest in the financial market, it gives them returns continuously. Most of the time capital market is on a good side, favorable side. Sometimes it goes to the negative or unfavorable side, but most of the time they get good returns. Whenever they get returns, they are very good, or when they put it into the bank, again they get a good return on it. Creation of assets takes place when a company issues new shares and debentures. Here we are talking about preference shares and equity shares, and debentures I told you, creditorship securities. Exchange of financial asset implies purchase and sale of existing shares and debentures and bonds. So financial market is a link between saving and investment process. When we talk about financial market, we have two things to consider. One, the savers, the other the investors. Here household are the savers, business firm are the investors, and of course financial market is here. So when the households don't go to the banks, they opt for the financial market, and these financial market become a good option for both the savers as well as investors. When in general terms we talk about investors, we talk about the people who want to invest in a company, but here we are talking in terms that business firms are the ones who actually invite the general public. So these public, the general people become the savers, and financial market is there in between, and that is why financial market works as the link, and business firms become the investor. They are the one who invite people to buy the shares of the company. Now, business is a part of economic system, and that consists of two main sectors. I told you, households and business firms. We just talked about it. Household save funds and business firms invest these funds. So financial market helps in this complete process, and it helps in allocative function also. What is allocative function? It means that it directs or allocates funds available for investment into the most productive investment opportunity. Productive investment opportunity means we are talking about the investment in the business firms. Now, the moment this complete allocative function is taking place, the process by which allocative or allocation of funds is done is called financial intermediation. Very important to understand that allocative function cannot happen without financial intermediation, and this is happening why? Because we want to invest our money into the most productive uses. Now, where would we go? If I'm working in a school, I am a professional, or I am a teacher, I am a underemployment, I cannot put money into any productive uses on a very large scale or get very high returns without investing my time and my energy into it or my efforts into it. So best way is to invest in a particular business firm, and that business firm puts it into the most productive uses. Now, allocative function, when followed properly, gives two benefits or two outcomes, or there are two consequences which happen. One, that economic growth happens in the, what happens is all scarce resources, they get allocated to the right place, and economic growth happens in the country or the economy. Second, higher returns to household in comparison to bank. Yes, undoubtedly financial market always bring higher return to the household. That is the reason people want to invest into the financial market, shares and debentures. So what are the two major alternative mechanisms available for allocation of funds? Like we talked about, banks and financial markets. These are the major questions which we need to discuss. So first question is define financial market. First question is define financial market. What does it help in? It helps in mobilization of funds or channelizing the funds. Then after talking about the definition, we talk about how it is an economic system and what are the two main sectors. So we talk about households and business firms. Then what do the household and the business firms do? We talk about that. Then we talk about the allocative allocative function, financial intermediation, and what are the consequences or benefits. Consequences in the sense results of following the allocative function. So actually it really happens to benefit the economy with the help of economic growth. Like I told you, economic resources or the scarce resources, not economic resources, the scarce resources get into the most productive use. So there is utilization of resources, and then higher return to the household makes it another good option. Okay, this is starting with the classification of financial market. When we talk about financial market, we classify it into two: money market and capital market. Then capital market further is divided into primary and secondary. Why I'm making this understand before the functions of financial market? Because we need to know that how financial market functions. So first of all, we need to know that what exactly constitutes a financial market in totality. Like I told, financial market is a link between savers and investors. Now when we talk about money market, we're talking about a market dealing in securities up to 1 year. Short term is a market for short term function which deals monetary assets whose period of maturity is up to 1 year. So when we talk about the money market, we are talking about short term working or short term functioning of the market, that is up to 1 year. Next comes the capital market. Now, capital market refers to facilities and instrumental arrangements through which long-term funds, both debt and equity, are raised and invested. So, once you reach a financial market, and when you talk about the long-term investments, you'll talk about capital market. When you talk about short-term securities or functions, you're talking about the money market. When you talk about primary market, it again is divided into, when you talk about the capital market, it is further divided into two: primary and secondary. Now, primary market is a market which deals with securities being issued for the first time. So, we also call it a new issue market. When the company issues its securities for the first time into the market and people buy it for the first time, initially, the first offer being made, new issue market. Now, secondary market is a market and the other name for it is stock exchange. So, where existing securities are bought and sold. It is a market for sale and purchase of existing securities, the stock exchange, the other name. So, primary market, the other name is new issue market. Secondary market, the other name is stock exchange. This was introduction to the classification of financial market. Financial market, we already know the definition. I'm repeating it. It is a link between investors and savers. Of course, it talks about the creation of financial assets like shares, debentures, etc., bonds also. So, we're dealing with the functions of the financial market. Now, what does function of financial market talk about? First, mobilization of savings and channelizing them into the most productive uses. The first thing which we did was financial market mobilizes the savings. Money which the household, the savers save, otherwise they would put it at home, will not go into productive use. The business firms, they want money. So what happens is the savers either go to the bank, and from the bank the business firms borrow in terms of loans, or the households go to the financial market from where the business firms actually create an investment and people invest. So, a financial market facilitates the transfer from savers to investors. It gives savers a choice of different investment and thus helps to channelize surplus funds into most productive uses. You have, of course, different investment opportunities, different firms are there. You can go to a bank also. You can talk about equity, preference, debentures, bonds. A lot of securities are available in the market, and along with that you can go to the bank. That is another option available to you. You can buy gold and silver, whatever you like. But when you talk in terms of financial market, different investment opportunities in terms of shares, debentures, preference shares, bonds, etc. Alright, facilitating price discovery. The force of demand and supply help to establish a price for commodity or service in the market. Of course, yes. Now, when you talk about demand and supply, who are the people who are supplying the funds? The household are the suppliers of fund. And who create the demand? The business firms. So, let's understand from that point of view. The forces of demand and supply help to establish a price for commodity. How the price gets established or service in the market? In the financial market, the households are suppliers of funds and the business firms represent demand. So the interaction between them helps to establish a price for financial markets or financial assets. Of course, yes. If a business firm is well known and the securities are already established in the market and people know about it, their demand would be the business firm's securities which are there in the market. In case the demand is more, the price would be more. The firm which are new, they come out with just very low equity shares. Why? Because they've just established themselves. And the savers are ready to buy. The savers are ready to buy even when that is the supply. When you talk about in terms of household, the suppliers, they are ready to buy. The savers are ready to buy. When they buy the initial equity, they expect it to rise after some time, and when they buy equity at a higher price, they expect again the rise. So that is what creates a demand and supply in the financial market. So as per the company, its reputation, demand is created and the savers supply the funds and they buy the securities. Next, providing liquidity to financial assets. Convertibility. Liquidity means convertibility into cash. Financial market facilitate easy purchase and sale of financial asset because there is a platform, common platform. In doing so, they can be easily converted into cash whenever required. Yeah, whenever you can sell. If you go to money market and you deal in money market instruments, they are highly liquid. You can sell them whenever you like. If you talk about equity shares, if the company has a good reputation, they can be sold in the market. Sometimes equity may not find a buyer, but most of the time they are easily convertible into cash. Holders of asset can readily sell their assets through the mechanism of financial market. Yeah, that is a place where you buy and sell your securities. So if you don't want securities or equity shares of one particular firm, you can sell that and buy of another firm. That's your choice. So easy liquidity. Alright, reducing the cost of transaction. Financial market represent value information about securities being traded in the market. Of course, yes, buyers and sellers both are there in the market. Both get the information which securities are doing well, so the buyers can easily buy it and the sellers can easily sell it. It's a common platform for both buyers and sellers. Had it not been there, a lot of time, effort, money would have been spent in searching for both the parties. So it helps to save time, effort and money that both buyers and sellers of financial asset would have to otherwise spend to find each other. It's a common platform for buyers and sellers. This is all about financial market introduction, function and classification. Next we'll be talking about is money market. Money market and its instruments and its features dealing in money market. Bye-bye.